What is good, trading family? It's Wednesday, July 8th. Your boy Wildcard in the chair, Rockstar on the shoulder, and honestly, yesterday was a straight-up blender. If you held semis into the close, you felt that one in your bones.
Quick reminder up top, nothing we say is financial advice. We are just two guys breaking down what we see. Do your own research.
Futures are telling us the hangover is still here. S&P futures off about 30 points. NASDAQ futures down 110. The VIX is parked at 18.36. The big tension. We got the first KOSPI circuit breaker since the COVID crash. The Korean won is still leaking, and oil just popped 6% because the Iran ceasefire is dead. It's three headwinds stacked on top of each other.
And that circuit breaker is what everyone's talking about, but it didn't fix anything. KOSPI futures are flat, no follow-through selling, but no buying either. The bounce in the Qs off $706 was mechanical, not conviction. Forced liquidation stopped, shorts covered. The real signal is the one. I pulled it right before we went live. USD against KRW at 1382.5. That's down 1.2% overnight, second straight day.
Right. The equity board flatlined, but the currency is still bleeding. That is capital leaving Korea, not just margin clerks doing their thing. And you know what that means for semis.
It means the unwind isn't over. It just moved from equities to foreign exchange. Korean institutions sell shares, convert to dollars, one weakens more, which makes the next round of selling even more attractive because they get more dollars per one. Self-reinforcing loop. And the catalyst to break it. Chinese stimulus, an Iran de-escalation, Samsung announcing a buyback. None of that is on the table today.
So let's hit the stories in order. KOSPI and the one first, because that is the mechanical force under the tape. Then the FOMC minutes later today, which just got way more explosive because oil repriced the inflation outlook, and we close on the ceasefire being dead. What it means for oil, bonds, and whether markets call the bluff a fourth time.
Agreed. Start with Korea.
Samsung missed badly. HBM margins collapsed, and they confirmed what the market has been pricing for 2 months. The KOSPI triggered that circuit breaker, stopped the selling cold. Qs hit 706, bounced to 710. A lot of chat is calling it support. I call it a pause. The disease is not the index level. It's that Korean fund managers are now looking at a triple whammy. Samsung's margin collapse, China launching an IBM into the Pacific this Monday, and the Iran ceasefire falling apart, which pushes up their oil import costs. Where does a Seoul-based institution put new money? Not in Korean equities. They buy dollars, they buy treasuries, they sit cash.
And the one proves that. At 1382, the outflow is structural. The SK Hynix ADR listing on Friday is the next pressure point. If the one keeps sliding, that ADR prices in at a discount to the Korean ordinary, and then you have a listed instrument dragging the underlying lower. That's margin call material for anyone who bought the local shares thinking the ADR would be a floor.
That death spiral is real. The wave trader algo is sitting right in the middle of this, holding AMD, AMBA, AOSL, Micron. It's not stopping any of them out. It either looks brilliant on Friday or catastrophic.
The algo is running its process. I'm not overriding it. But personally, my gut book is holding BYD on a separate battery thesis, and I'm not adding anything else.
My TFT algo is taking the beating on ASML right now. My paper account is nearly 10,000 in cash. I'm not buying the dip, not yet.
Neither am I. Now the FOMC minutes, they drop at 2 p.m. Eastern. The key thing, the committee wrote these minutes when West Texas Intermediate crude was around $70 a barrel, maybe 71. Oil popped 6% after the ceasefire died. So the minutes are going to reflect a world where energy was still disinflationary. That is not today's world.
Williams was dovish leaning yesterday, said he's more positive on inflation because of energy. That was before the headline. Waller came out hawkish, said the Fed won't bail out the government. So the debate inside the committee was already split. Now oil is at 74.68, and if it sticks, the next CPI print gets a tailwind, not a headwind. The minutes are going to feel stale the moment they hit.
Exactly. The tension is between what the Fed was thinking at $70 and what the market is now pricing with the 6% oil spike. If the minutes show broad comfort that inflation is cooling, the bond market might call them behind the curve. We're already seeing real hike odds tick up in the short end. The 2-year yield could push higher if the oil move gets sticky.
And that rips through tech harder, because if the Fed can't cut because oil is keeping inflation sticky, then duration gets whacked. and the semis that were supposed to recover on lower rates don't get that bid. The KOSPI circuit breaker might have been the first domino, but the second is the Fed's reaction function being repriced tonight.
The minutes themselves aren't the trade. The gap between the minutes and the current crude price is the trade. That's what I'm watching.
Now the big one. The ceasefire is dead. Trump said it explicitly, called them scum, said it's over. NATO's Rutte backed the strikes. Crude jumped 6%. German bonds sold off on the inflation scare. This is not a fragile piece that might crack. This is an active escalation. The war premium is back.
And here's the honest question we both have to ask. Is this time different? The last 3 times we got an Iran headline pop, oil faded within days because a peace deal swooped in. But this time, the US president killed the deal with his own words. That is a different structural floor. It may not mean oil runs to 90, but it means the downside call option on a quick peace deal just got priced out. West Texas Intermediate crude at 74.68, up 6% in one session. That is not a fake out.
Right? The floor just moved up. And if you're an energy trader, you don't fade this until you see a willingness to re-engage diplomatically. The only thing that cools crude now is either a demand shock or a V-shaped de-escalation nobody sees coming. I got burned on the energy sector ETF last time when the peace deal hit. I'm not putting personal cash on this until oil holds the gap for a couple days, but I'm not short either.
Connecting it to the macro, higher oil means sticky headline inflation. That means the Fed's path gets narrower. Rate cuts get pushed out. Duration assets, long bonds, growth tech, sell off. The rotation into value, financials, and energy accelerates. That's exactly what the sector board is telling us.
Let's glance at earnings and the calendar before we hit rotation, because it's a quiet week on the print front. Samsung's miss is the headliner, and we already chewed on that. No other marquee names lighting up today. The rest of the week is thin, so we can move.
Economic calendar, though, today we get IBDTIPP, economic optimism, consensus 45, prior 42.5. Later, the Atlanta Fed GDP now, which is running at 1.2% growth for Q2. It might tick up after yesterday's data, but nothing huge. Tomorrow morning, China CPI and PPI drop. CPI, consensus 1.1%, prior 1.2. PPI consensus 4.2, up from 3.9. That's the number that moves the reopening thesis.
China PPI rising tells you factory gate inflation is picking up. If it comes in hot, it complicates the narrative that Beijing can keep stimulating without stoking prices. If it misses, it reinforces the growth scare that's hammering Korean exports. Either way, it's a risk event for the KOSPI. I reopen tonight.
And Friday morning, we get Japan PPI, consensus 6.8% up from 6.3. That number matters for the Bank of Japan and for the yen carry trade. If producer prices spike, it pressures the BOJ to normalize, which could strengthen the yen and unwind carry trades. That's a second-order hit to risk assets.
All right, rotation. Financials are up over 4% on the week. The financial sector at 4.34. Communication services, XLC, up 2.91. Healthcare, up 2.3. While industrials, utilities, and tech are bleeding. Tech down 3.36. That's real money moving from growth to value, from duration sensitive to inflation. Hedged.
Energy isn't even in that leaderboard directly, but the energy sector ETF will get the bid if oil holds. Defense is the quiet beneficiary. V just got a $31 million German contract, tiny, but the narrative is that Europe is rearming. You add China's missile test and a dead Iran ceasefire, and suddenly defense spending has a multi-year tailwind that isn't fully priced.
But here's the bear case on energy. The energy sector, ETF, is already pricing in high 70s crude. If the market sniffs that this Iran escalation won't actually disrupt supply, oil fades to 70 again, and energy stocks give back the pop. You buy energy here, you're betting the war premium isn't a head fake for the 4th time. That's a binary bet.
Same logic for defense. L3 Harris, Lockheed, Raytheon are all near highs. They've already run on the Ukraine and Middle Eastern tensions. The incremental buyer has to believe the China missile test changes the calculus for Indo-Pacific spending. I think it does over a 5-year horizon, but the next few months are not a straight line.
International overnight tells the same story. The Hang Seng rallied nearly 3%, probably on bargain hunting and hopes for Chinese stimulus. Shanghai Composite fell 1.7% though, so the mainland wasn't buying it. Japan's Nikkei down over 2%, the DAX down 2.1%, the FTSE down 1.4%. Euro Stoxx 50 off 1.75. It's a risk-off session globally, except Hong Kong doing its own thing.
The carry trade is worth a mention. Dollar yen up 0.2%, holding steady. No sudden unwind today, but the Japan PPI on Friday could be the trigger. If it pops, yen strengthens, and that unwinds trades that are short yen, long risk. That would hammer US tech and semis even more.
And that circles back to our hot theme, the oil, energy, and defense repricing. The second-order effect of higher oil is inflation expectations, getting unanchored just as the Fed thought it was winning. That hits bonds, which hits multiples on growth stocks. Defense gets a bid from the geopolitical fear, but it's not a clean trade because it's tangled up with the fiscal side. Higher defense spending means more issuance, which pressures yields too. The whole cross-asset picture is messy.
The bull case for energy right now is simple. Supply discipline from OPEC+, a geopolitical premium that's not going away, and a China that's still buying at these levels. If West Texas Intermediate crude closes above 75 for a few sessions, the technical picture breaks out and you get CTAs piling in. That could push crude to 80 fast.
The bear case is a recession narrative. If the Fed stays hawkish and the economy slows, demand destruction solves the oil spike. Plus, strategic reserve releases are still a tool. The White House could jawbone prices down. The market's been trained to sell energy rips for 2 years. Breaking that habit takes a real supply event.
Which brings me to the one thing I want to flag. We don't know which way this breaks. Last time we were too certain oil would fade and it cost us. My paper account is sitting in BYD and cash. No new oil bets. The wave trader algo is letting the semis ride through the storm. I trust the process, not the narrative.
Same here. My gut call account is all cash. I learned from the energy sector ETF call. The market doesn't care about my convictions. Right now it's paying us to watch, not to act.
So what we're watching tomorrow, first, China, CPI and PPI before the open. That will set the tone for the Asian reopen. Second, KOSP. Reopening tonight, we need to see if the one stabilizes or if the equity selling resumes. Third, SK Hynix ADR listing on Friday is the real litmus test for the Korean unwind. And fourth, West Texas Intermediate crude at $75. If it closes above that level, the energy breakout gets serious.
That's the board. Keep your head on a swivel. Manage risk. Don't be a hero. From TB and myself, we're out. Catch you tomorrow, trading family. Go make it a great one, not a reckless one. Peace.